Hello and welcome to this month's edition of Coffee with Scott. Obviously, I'm Scott. I'm going to be doing the interviewing today for once, so this will be a nice change of pace. I have with me here Brian Haselden. He's our
Hello.
National Sales Director. Brian may not have written the book on insurance, but he certainly knows the guys who did. He's been in the business for 39 years and is pretty much our in-house resident expert on the topic of insurance. So thank you for joining us today,
Thanks
Brian.
for having me, Scott.
So let's talk a little bit about just basically types of insurance. What types of insurance are out there?
Well, the three types of insurance that we work with here at ISC, there's really, think of it this way, it's live, die, or something happens along the way. So we represent life insurance, which is to protect families in the event of a premature death. If you're not there to provide income for your family, the insurance could step in and provide some money so that there's not a drastic change in their lifestyle. The second type of insurance is for those that live too long, just the opposite. And in fact, a lot of surveys have said that people fear running out of money in retirement much more than dying themselves. So we like to provide income that you can't outlive. That's a big want for a lot of our clients. And then the third is getting sick along the way. Most people have health insurance, but they may not have long-term care insurance. There's very little that the government provides in the way of assistance. And the good news, bad news scenario is that assuming that you live to 65, there's a 70% likelihood that you'll need care before you die, and that is fully borne by your retirement savings unless you have some type of insurance. So that's the bad news. The good news is people are surviving cancers, heart issues, other things that you may have died in previous generations, but medical science still hasn't figured out a way to prevent that. But we've figured out a way to survive those, but now we're going to need a little help in the end stages of our life.
Can you talk a little bit about the cost of that care if something does happen to you and you have to use your life savings towards it, like just national averages?
If we look at national averages today, for a nursing home stay, semi-private room is about $80,000 to $100,000 a year. It varies by region. Generally, the more urban the region, the higher the expense. But count on $80,000 to $100,000 for a male. The average length of care is about 2.5 years. For a female, it's 4 years. So it's a significant amount of money. Most people would prefer, and the trend is towards home health care because a lot of that expense is living somewhere else. And that averages today around $4,000 a month, or let's call it $50,000 a year. So certainly everyone would want to stay in their home
Sure.
if they could. And again, we try to look at, I've been doing this for 30 years in terms of long-term care planning, looking at the progression of staying in your home as long as possible so that you don't have the higher expense and it's more comfortable.
Sure, of course. So talking about that a little bit, it seems like in recent years, in the 20 plus years I've been here, the long-term care insurance has evolved and in fact been kind of priced out of the market. How has the market responded to that with innovations in like life insurance, et cetera?
So that's a great question. The modern long-term care insurance was really born in the late 80s and early 90s, practically speaking. And at the time, it was a new product. There wasn't an actuarial science like who's going to buy it, who's going to need it, who's going to keep the insurance, how long are they going to need it. All those were kind of unanswered questions and best guesstimates by carriers. So over time, they figured out that people are keeping the policies and they're using it more than they had originally predicted. So those costs have skyrocketed over the last, particularly over the last 10 years, as those claims on policies bought 20, 30 years ago came rolling in. So today we've gone from 40 carriers to I think around 4, give or take. A lot of carriers have stopped writing it altogether. those existing policies have taken significant rate increases in order to keep them legitimate and the companies in business. So what happened is in 2008, as part of the Affordable Care Act, originally long-term care was going to be provided in that package. Well, just that component alone is worth $2 to $4 trillion in annual expenses. Wow. Because a lot of that care is given by family members and the like. So in order to pass the Affordable Care Act, they had to take that out of the package. It just wasn't practical for the government to come in and pay those bills. So they said, okay, now that we've passed the rest of the package, the health insurance part, what are we going to do with all these baby boomers that are going to hit retirement age? They're staying alive, they're surviving strokes, heart attacks, cancers that previous generations did. How are we going to provide for that? And so really what it came down to is a creation of what is today known as a hybrid product. A hybrid product is simply life insurance that prepays the death benefit while you're living to cover your long-term care costs. So that was codified quickly thereafter in 2008, and products started arriving on the market in 2010. So we're still under 15 years into this style of plan. And really what it amounts to is you buy life insurance. Let's say you buy a $500,000 policy. In the event that you need long-term care, now in the Internal Revenue Code, you can take this year up to about $140,000 a year tax-free of that death benefit while you're living. So the real change is that originally people bought life insurance to protect their family. Let's say you live to retirement and beyond, and now you find yourself needing care. You can repurpose that life insurance that you bought to protect your family to take care of your health care bills. And by using that money tax-free, you avoid having to dip into your retirement savings.
Well, it sounds like there's a compelling reason if you own an older policy maybe to look at that, right? If it didn't have that feature and now it does post 2008, but would it be a lot more expensive for somebody?
It's really not, because the interesting thing is as medical technology is advanced and people are living a little bit longer, the actual price of the life insurance has come down. Now that's somewhat offset by the prepayment. They're factoring that in, of course, but it's not dramatically different. And in a lot of cases, it's far less expensive than going out and buying a separate long-term care policy. You're buying one policy that's doing double duty. Right. So it's a little bit more efficient that way. But yeah, I think that for the stakes involved, we're talking about your retirement savings. We're talking about protecting your family. It makes a lot of sense to get an informed second opinion. We provide them free. The reason I'm here is that many planners and financial advisors are experts in investments and retirement income planning and the like, but they don't concentrate or focus a lot on insurance. You can't be an expert in every field. So I come in to provide that expertise for the firm and give people an objective second opinion. And then they can, if we find something that we can improve their plan or something that's amiss, we can inform them, and then they can decide for themselves what course of action they want to take.
Well, it seems like that's a pretty important part of building like a financial plan, right? I mean, if you're not insuring your house, it burns down, how does that affect you? So that makes perfect sense as the industry moves more towards a holistic financial planning type model, right?
It's a big component, and if you look at the grand scheme of things, people, in terms of household budgets, families are typically paying hundreds, if not thousands of dollars a month in insurance premiums. So we would certainly want to make sure that they're getting the most bang for their buck.
Awesome. Okay, well, that's all the time we have for today. Thank you, Brian, for joining us. And as always, we ask that you like, subscribe, and follow if you enjoy these talks. Thank you very much.